Sand Hill Road, the gatekeepers of risk capital. Menlo Park, California. If you drove past it without knowing, you might not even look twice. No neon, no giant logo. Just low slung buildings, manicured hedges, a discreet sign with the firm's name in clean, conservative letters. This is Sand Hill Road. It looks boring. It is anything but. Inside these offices, for decades, people have been making bets that will shape what shows up in your phone, what software runs in your office, what companies your kids dream of working for. Not by building products, by writing checks. To understand Sand Hill Road, you have to go back before there was any road to speak of. Back to the 1950s, when Silicon Valley was still mostly orchards and defense contracts, and startups were just small electronics companies trying to get off the ground. At the time, if you were a young engineer with a crazy idea for a new transistor or computer, you had limited options. You could beg a bank, you could convince a big company to hire you, you could go back to your lab and hope someone noticed. Banks were not in the business of funding dreams. They wanted collateral, cash flow, something solid. The kind of risk that might change the world looked, on a balance sheet, like the kind of risk that might just lose money. Then, out here near Stanford, a pattern started to form. A brilliant but difficult physicist named William Shockley opened a semiconductor lab. Some of his best engineers got fed up, quit en masse, and founded a company called Fairchild Semiconductor. To get Fairchild off the ground, they needed money. A New York banker named Arthur Rock helped them secure it. Fairchild became a seed crystal. Its alumni went on to found Intel and a dozen other firms. The lesson was simple and explosive. If you back the right group of people early, the payoff can be enormous. In the 1960s and 70s, a handful of people decided to turn that lesson into a business model. Not as hobbyist angels writing small personal checks, but as firms dedicated to funding startups. They build a structure that will become standard. A partnership that manages funds. The money in those funds mostly comes from others, wealthy families at first, then pension funds, university endowments, foundations. These outside investors are limited partners. The partnership that picks the companies is the general partner. The deal is straightforward on paper. The limited partners put up most of the money. The venture firm charges an annual fee for managing it and, crucially, takes a share of the profits if the investments go well. 2 and 20 in shorthand, about 2% of the fund each year as a management fee and around 20% of the eventual gains as carry. The firms then go hunting for young companies. They buy equity, not debt. No fixed interest payments, no collateral. Instead, a slice of ownership in exchange for capital and advice. If the company fails, the equity is worth zero. If it succeeds, that slice can be worth more than the whole fund. It is a model built on a power law. Most bets will lose or muddle along, but a few, if chosen well, will be spectacular. As the 1970s roll into the 80s and 90s, Sand Hill Road becomes the physical shorthand for this new way of financing. Names that will echo through startup lore hang their shingles here. Kleiner Perks, Sequoia Capital. Later, Benchmark, Axel, Greylock, Andreessen Horowitz. From their offices, partners drive a few minutes down to Stanford to meet professors and grad students who might be the next founders. They sit across from teams in hoodies and polo shirts, listening to pitches about routers, graphical interfaces, online stores, search engines, social networks. Sometimes they say no quickly. Sometimes they say yes, write a relative small check, and take a seat on the company's board. They're not just ATMs. They are coaches, referees, and occasionally bouncers. They push founders to focus. They introduce them to executives, lawyers, PR people. They help hire professional CEO if the original one is in over their head. In exchange, they expect something very specific: growth. In venture capital, it is not enough to run a nice, profitable small business. The holy grail is scale. You're not building one good restaurant. You're not building the next McDonald's. You're not writing one good app. You're building the platform that all other apps sit on. This focus on scale shapes everything. Venture firms encourage companies to reinvest every dollar in expansion. More engineers, more salespeople, more servers. Profit can wait. The payoff comes if and when the company goes public or gets bought for a large sum. At that point, the early equity converts into liquid wealth and the fund can return money to its limited partners. If you chart this philosophy, it looks like a hockey stick. Long, flat early years with losses, then, hopefully, a sharp kink upward into exponential revenue. Of course, many curves never kink. They just fizzle out. The art of Sandhill Road is deciding which squiggles might become hockey sticks. From the outside, we mostly hear about the hits. The early investment in Apple, the checks that backed Cisco, Netscape, Google, Yahoo, Amazon, Facebook, Airbnb, Stripe. The early board meetings where a handful of people agree, in a bland conference room, on moves that will eventually influence billions of users. But venture is also a graveyard. For every company that becomes a household name, there are dozens that closed their doors, pivoted 3 times until they ran out of runway, or sold quietly for a fraction of what their investors hoped. The partners on Sandhill Road know this. They build it into their math. If a fund backs 20 companies, they do not expect all 20 to do well. They hope a few return the fund many times over. In that sense, they are not just picking winners, they are buying options on possible futures. Because of this, venture capitalists accumulate a strange kind of soft power. They are not elected, they are not usually on magazine covers. But they decide, in meeting after meeting, which technologies and teams get a real shot at existing. They pattern match consciously or not. This can be good. Having seen dozens of startups, they spot common failure modes before founders do. Messy cap tables, unclear markets, ego-driven spending. It can also be limiting. If your pattern of a successful founder is a young, technically minded man from a narrow set of schools, you may overlook brilliant people who do not fit that mold. Critics point to homogeneity in the venture world. Few women in partner seats for most of its history, underrepresentation of black and brown founders, a bias towards certain geographies and ideas. Supporters argue that the ecosystem is evolving. New funds, angel investors, and grassroots networks are changing who gets heard. Both can be true. Sandhill Road remains an amplifier. It can magnify the best ideas. It can also magnify blind spots. The culture of venture bleeds into the culture of startups and the broader market. When the dot-com boom of the late 1990s inflates, venture capital fuels it. Companies with no profits and vague business plans raise money at soaring valuations, buy Super Bowl ads, then crash. In the aftermath, the people declare the model broken. Then in the 2000s, another wave rises. Web 2.0, social, mobile, cloud. Once again, Sandhill Road pours in money. This time, many of the underlying technologies are more mature. Broadband is widespread. Smartphones change behavior. Ad models improve. Out of the froth, real giants emerge. Google, Facebook, LinkedIn, WhatsApp, Uber. The ups and downs reinforce one trait above all in the people who sit in those partner chairs: a high tolerance for looking wrong in the short term. Funding a ragtag team working on search when Yahoo and AltaVista already exist. Backing a site where college students rate each other and post photos. Believing that people will type their credit card numbers into a web page. From a distance, after the fact, these bets look obvious. At the time, they are not. Today, Sand Hill Road is not the only place where this game is played. New venture hubs have sprung up in San Francisco, proper in New York, London, Berlin, Bangalore, and Beijing. Late-stage money comes not just from traditional venture funds, but from hedge funds, sovereign wealth funds, corporate venture arms. Crowdfunding and angel syndicates let individuals chip in smaller amounts. But the archetype remains: a small partnership, raising a fund, taking a slice of the upside, betting on founders chasing outsized markets. The product has shifted too. In the 1970s, it was chips and hardware. In the 1990s, browsers and routers. In the 2000s, social networks, software as a service, smartphone apps. Now, AI, climate tech, fintech, crypto, biotech. Each generation of VCs claims they are backing not just companies, but platforms, ecosystems, paradigm shifts. Some are right, some are selling themselves as much as their founders. Strip away the jargon and mythology, you can describe the function of Sand Hill Road in a single sentence. It is a machine for turning other people's savings into bets on very uncertain ideas. Your pension fund, your university endowment, your company's surplus cash, some of that money may be quietly allocated to alternatives, including venture capital. That money flows into funds. The funds flow into startups. The startups pay salaries to engineers, designers, salespeople. Some of them will build things that change how you live and work. Others will burn through the cash and vanish. Either way, the risk is being absorbed at one remove. The person whose retirement account is ultimately backing all this might never know the names of the tiny companies that ate their capital and the few that made it back with interest. They just see a line item: venture fund, 12% IRR. There is something almost cinematic about all this. The secretive partner meetings, the dramatic pivots, the Hail Mary product launches, the big IPOs ringing the bell on Wall Street. It makes for good stories. It also helps sustain a belief that the way to win in markets is to find the right geniuses early, pick the right stocks, choose the right funds, to outsmart everyone else. But while all this is happening in California conference rooms, a very different idea is brewing in suburban Pennsylvania and New Jersey. A man in a grey suit with a slightly stern face and a love of blunt language sits in an office at an upstart mutual fund company and stares at a set of numbers that annoy him. Those numbers show what happens when ordinary investors try to beat the market by buying active funds. High fees, high turnover, lots of trading. And, for most people, results that lag behind the broad market once you account for costs. He reaches a radical conclusion. If you cannot reliably pick the winning managers, and most traders lose to the market over time, maybe the answer is to own everything. All at once, at the lowest cost possible. And then leave it alone. This man's name is John Bogle. The company he builds is Vanguard. Next time, we will leave the selective pitch meetings of Sand Hill Road and step into a world that tells you, essentially, to stop trying to be clever. We will talk about how Bogle turned the idea of the index fund from a laughed-at curiosity into a quiet revolution. shifting trillions out of high-fee stock picking and into low-cost baskets of the whole market. If Sand Hill Road is where a tiny number of companies get their shot at rocket fuel, John Bogle and Vanguard will show us what it looks like when everyone else is invited to own the launch pad itself.